Your 30s are a hinge point. What you do with money now becomes the freedom you have later. This isn't hype, it's a simple plan you can actually follow. Welcome to episode 65. I'm going to walk you through one practical strategy you can use to build real wealth in your 30s. It's not a magic trick or a get-rich-quick scheme. It's a repeatable 12-week sprint that fits real life. The idea is to build a clear money map, automate the boring stuff, and then make deliberate investing choices that compound over time. You'll hear a lot about budgets and returns, but the core is discipline plus simplicity. We'll break it into 6 moves you can run every quarter. Move 1. Build your money map in one page. Start with a single, honest snapshot of where you stand. What's your net worth? How much do you owe and what do you own? How much money comes in each month and where does it go? The map also includes your emergency cushion and your future targets. Keep it simple. Draw 3 rows: assets, debts, and monthly cash flow. In assets, list cash savings and investments. In debts, list your loans and credit cards, including interest rates if you know them. In cash flow, note fixed costs, variable costs, and the amount you'd like to save each month. This map isn't a trophy, it's a compass. Update it every 90 days, especially when your income or expenses shift. The act of writing it down makes the plan real, not an idea you'll get to someday. Move 2. Nail your gaps with a tiny, ruthless budget. A budget is a guardrail, not a jail cell. The goal here is clarity, not guilt. Look at your fixed costs, rent, utilities, subscriptions, and your debt payments. Then set a small, automatic savings target you cannot miss. A simple way to do this is to auto-route money before you see it. Have your bank transfer a chunk to savings the day you're paid. Put another chunk toward a retirement or investment account. Leave enough for essentials and a modest cushion for life's surprises. If you want a concrete rule, try the 50-30-20 idea with a twist. 50% needs, 30% wants, 20% savings and investing. If that feels tight, start with 60-20-20 and grow toward the ideal. The key is consistency, not perfection. Move 3. Automate everything that matters. The easiest way to stay on track is to automate. Automate your savings, automate your debt payments, and automate your investments. When the money flows without you thinking about it, you don't have to rely on willpower. Set automatic transfers to a high-yield savings account for emergencies. Schedule regular payments to any high-interest debts to shrink them faster. And set up automatic monthly contributions to a simple investment account, even if the amount is small to begin with. Automation reduces the chance of slipping. It also builds a habit, and habit is what compounds over years. You don't need to be perfect, you just need to be consistent. Move 4. Invest with a simple, durable plan. Here's the core of investing in a way that makes sense for most people in their 30s. Keep it simple and broad. A straightforward portfolio uses broad stock and bond funds rather than picking winners or timing markets. Think in 3 sleeves: domestic stocks, international stocks, and a bond sleeve for ballast. If you're younger or comfortable with more risk, you can tilt toward stocks, for example, 70% stocks and 30% bonds. If you're closer to the middle of your 30s or prefer less volatility, a lighter stock allocation works too, like 60-40. The specific picks don't matter as much as the structure. You want low fees, broad diversification, and automatic rebalancing. If you're using funds, aim for total market or total world index funds for the stock portions, and a broad bond fund for the fixed income sleeve. In practical terms, you might set up 3 funds: U.S. total stock market, international total stock, and a broad bond index. You'll add to them every month, keeping your allocation roughly steady over time. Rebalance once a year or after big market moves, but don't chase every tiny swing. Move 5. Max out tax-advantaged doors and protect what you have. Make sure you're using the tax-advantaged accounts available to you. If your employer offers a 401k or similar plan, contribute enough to get any match. This is free money. Open an IRA if you can, and consider a health savings account if you're eligible, since it can serve multiple purposes. Beyond taxes, protect what you're building. Get basic life and disability coverage if others rely on your income. Consider a will or estate plan, even a simple one, to guide what happens if you're not around. These steps aren't exciting, but they stop you from losing the gains you're working so hard to earn. Move 6. Build a quarterly habit you actually enjoy. The 12-week sprint is 4 blocks of 3 weeks each, with a final review. At the start of each block, pick one thing to improve. Pay down a chunk of debt, increase your savings rate, or add a small amount to your investment monthly. Keep the habit simple. Don't try to overhaul every part of your life at once. When you finish a block, write down what worked and what didn't. Then reset for the next 3 weeks. The point isn't to be perfect, but to finish what you start and build momentum. Now let's add a practical starter kit for the sprint that isn't overwhelming. Starter kit, a one-page money map as your operating document. A basic budget with 2 lines you actually look at every week. An auto-pay plan for savings and debt payments. A 3-fund investment plan with automatic contributions. A small emergency fund target you can reach in a few months. With these basics, you're not chasing a moving target. You're creating a steady engine you can tweak as life changes. A few practical tactics to avoid common traps. Lifestyle creep is real. When raises come, save more first, then upgrade your life, not the other way around. Debt is expensive. If you have high-interest debt, target it early with a quick payoff plan, even if it means slowing other saving for a moment. Don't try to pick hot bets in the stock market. The broad, low-cost approach wins over time for most people. Common mistakes to skip: waiting for the perfect plan. If you start with something reasonable and adjust, you'll learn faster than chasing perfection. Overcomplicating your portfolio. A few broad funds beat a lot of frantic trading. Ignoring tax and protection, money sits in a plan that works only when you protect it. A realistic roadmap for your 30s. Months 1 to 3. Build the map, set a budget, and automate the first 3 transfers: savings, debt, and retirement investments. Open the accounts you need if you don't already have them. Months 4 to 6. Implement the 3-fund investment plan with steady monthly contributions. Add a bit to your emergency fund if you're short. Months 7 and 9. Review your progress in detail. Rebalance roughly and adjust your savings rate based on income changes. If you've got extra cash, deploy it toward high-interest debt or the investment sleeve. Months 10 to 12. Solidify the habit. Do a full year-end financial check. Net worth, debt levels, and the balance of your accounts. Plan the next year's sprint with a few concrete targets. Why this works in real life: it fits a busy life. Automation takes the heavy lifting off your shoulders, and the sprint keeps you moving without burning out. It compounds over time. Small, regular contributions add up as markets move and your income grows. It's resilient. If you lose a job or face a big expense, your emergency fund and simple portfolio give you a buffer. What this means for your week: spend 15 minutes a week on the money map. Update numbers, track 1 win, and note 1 area to improve. Set 3 automatic transfers on payday. Make the first go to an emergency fund, the second to debt payoff or savings, the third to investments. Review your plan quarterly. Look at what you contributed, what your investment mix looks like, and whether you need to adjust anything for life changes. A quick mindset note: you don't need to become a finance nerd to win at money in your 30s. You need to be honest about where you are, consistent about what you do, and patient about what your plan can do over time. Wealth isn't a sprint you finish, it's a path you walk every day. If you want to tailor this further, start with 2 questions. What would a 12-week sprint look like for you right now? And what's the smallest habit you can start this week that will stick for a month? Answering these 2 questions will set you up for momentum rather than overwhelm. Now, a word about realism. This plan is designed to be doable even if you don't earn a lot, if you have debt, or if you're juggling a lot of life costs. It's about steady progress, not dramatic moves. The compound effect of small, consistent steps is the quiet engine behind lasting wealth. If you're watching this and you're ready to start, pick 1 action today. It could be setting up an automatic transfer or drafting your money map. Do it now and tell yourself you'll do the next one tomorrow. The sequence matters more than the speed. As you build this in your 30s, you'll notice a difference in how you handle money during the normal chaos of life. You'll feel more in control, and your money will feel more like a tool than a threat. That shift is what finally makes wealth feel possible and, yes, sustainable. Remember, you're in this together with a lot of people who started where you are now. Small, steady steps outlast big bursts of energy and fade away. Your future self will thank you for the habits you're building today. If you found this practical and useful, give it a like, subscribe for more real, no-fuss money guidance in future episodes, and drop a comment with the first habit you're going to start implementing this week. What will you automate, and what will you invest in first? Let's talk about it.